Hello, this is Nataraja Upadhyaya. Welcome to this special mutual fund report, which is about how the mutual funds gave a knee-jerk reaction for the budget news on July 24th. And I did this analysis by comparing the mutual fund numbers as on June 23rd, that is one day before the budget. Basically, the data downloaded on the morning of June 24th for that. And then comparing it with data on next day after the budget news, which is July 25th morning, reflecting July 24th data. So how one day data impacted the averages, we'll see. Now, this is done more out of curiosity and to understand the mutual fund performances better on such newses. So I have now shown you here the typical mutual fund summary I create when I do a monthly top 50 analysis on a weekly basis, except I have done it for specific data as on July 23rd, which is day before the budget, and on the day of the budget, 24th. So any difference here need not be all attributed to the budget news. However, you can sentimentally expect budget news to influence these numbers somewhat. So let us dig into the details to appreciate the impact of the budget news on mutual fund performance. For that, first let us see our baseline, which is one day before the budget. Entire mutual fund universe has 100 and 1060 1615 mutual funds. Out of 860 mutual funds belong to equity, 218 for hybrid, 484 for debt funds, and 53 for commodity funds. Commodity funds are primarily gold and silver in India. Now, if you look at the entire universe of mutual funds, the 1 week return was minus 0.74%. 1 month return was plus 2.01%. 3 month return was 8.55%. 6 month return was 13.51%. 1 year return was 26.65%. So the mutual funds returns were subdued for the last two weeks. So we see some average numbers here. Now let us compare it after the budget. This minus 0.74% for the week became minus 1.01%, which means mutual funds in general corrected after the budget news. 2.01% became 1.80% for 1 month return. Again, there is a fading return here. 8.55% become 8.10%. 13.51% became 14.45%. On the 6 months basis alone, there has been an improvement post budget. What it means we'll discuss now. 26.65% become 26.41%. So what it means is that only in 6 month return basis, post budget returns on average were better across the mutual fund universe. What it means is that the mutual funds that did well in the last 6 months did slightly better compared to the leaders before those 6 months. That's all it means. That means the current trend of mutual fund leaders maintained the leadership is what we could say while they were correcting. Now let us look at the equity funds performance, which is the most important focus of this analysis. Let us go by each number carefully. Top 50 equity funds average based on 1 month return. So typically what happens is 1 month return leaders tend to be way ahead of the averages. So here also 1 week return was positive at 0.81%. 1 month return was healthy 9.54% for the top 50. 3 months performance was 16.02%. 6 month return was 14.18%, and 1 year return was 36.23%. Post the budget, this 0.81 became 1.20%, an improvement. 9.54 become 10%, an improvement. 16.02 become 16.40%, an improvement. 14.18% became 15.83%, an improvement. 36.23% became 36.61%, a marginal improvement. So what it means that top 50 equity funds based on 1 month return maintain their leadership and remained positive even after the budget news. So that means that mutual funds performance of the leaders of top 50 1 month basis maintain their leadership is what we have to notice here. Let us look at bottom 50 based on 1 month return had a correction of 3.3% for the week, minus 1.99% for the week, 10.10% return for the month, sorry, minus 1.99% return for the month, 10.1% for the 3 months, 15.34% for 6 months, and 28.46% for the 1 year. The same number, this minus 3.3 became minus 3.49 for the week, minus 1.99 become minus 2.04, 10.1 become 9.9, 15.34 become 20.31, and 28.46 become 39.48. So clearly for the 6 months and 1 year basis, post budget, the returns were better for the bottom 50 equity funds based on 1 month return. So what it means is that the top performers based on 6 months and 1 year, that kind of funds got into the bottom 50. So the budget news had some impact on these leaders, long-term leaders or medium-term leaders for 6 months and 1 year, and they came into bottom 50, which is kind of a correction and a churn out of leadership is what we could say. Next one is top 50 equity funds average based on 1 year return. As on 23rd July, 1 day before the budget, which was minus 2.51% for the week, 2.21 for the month, 15.64 for the 3 months, 28.66 for the 6 months, 73.09 for the year. These numbers become 2.51 become 2.92%, that is minus 2.92%, plus 2.21 became 1.53%, 15.64 became 14.23%, 28.66 become 31.32, 73.09 become 71.66%. Here again, there has been an improvement on the basis of 6 months only post budget, and all other numbers kind of subdued. So again, the performers in the last 6 months had a better return post budget. Next, bottom 50 equity funds average based on 1 year return. These are the bottom 50 based on 1 year return. This minus 1.43 become minus 1.36%, which is an improvement for the week. 1.22% become 1.03%, which is not an improvement. To 7.87 become 7.12, not an improvement. 10.73 become 11.48%, which is an improvement. 7.27 becomes 7.32, which is an improvement. So within bottom 50, there was a better return, you could say, in many timelines post budget. So that means there is a churn out in the bottom 50 also. Entire equity mutual fund universe average at the equity minus 1.29 for the week become minus 1.47, further correction. 2.9 become 2.76, kind of a correction. 12.74 become 12.09, kind of a correction. 19% become 20.86, an improvement. 39.67 become 39.48, kind of a correction. So again, on a 6 months basis, the numbers improved again. Let us look at hybrid funds. Typically what happens in hybrid funds is it's a mix of equity funds, debt funds, and in some cases it's also commodity funds. So we are not going to get into much details. We'll just see at high level how the top 50 hybrid funds did. Minus 0.61% for the week became minus 0.79%, a correction. 3.11 for the month became 2.95%, correction. 9.62% became 9.32%, correction. 15.21 became 16.23, which is an improvement for 6 months. 29.41 became 29.21, which is again a correction. So there is a similarity with respect to how the hybrid fund performed when compared to equity funds when it comes to 1 month top 50. Let us look at hybrid 1 year top 50. minus 0.91 for the week became minus 1.12 correction. 2.43% became 2.28 kind of a correction. 9.97 become 9.47 a kind of correction. 16.6 become 17.85 improvement. 34.06 become 33.7 again correction. Similar results. Entire hybrid mutual fund universe average minus 0.39 become minus 0.57 correction. 1.86 become 1.74 correction. 6.82 become 6.49 correction. 10.99 become 11.62 improvement. 21.45 become 21.29 correction. So it is similar to equity funds performance. Entire debt mutual fund universe average, there should not be any impact due to budget. However, there might have been an indirect influence because there was no new SOPs for debt investments in terms of tax break. So there could have been some disenchantment or disappointment. See, the 0.19 for the week became 0.14 correction. 0.67 for the month became 0.68 an improvement. 2.33 became 2.28 correction. 4.25 became 4.18 correction. 7.59 becomes 7.58 minor correction. But it could say it is negligible with respect to debt funds. When it came to commodity funds, there has been a huge impact. Minus 1.33 became minus 5.19%. Initially, I did not know, so I didn't mention in the blog, but I went back to the blog and corrected. This is because of the blog, the budget news. In budget, they reduced the import duty on gold and silver by 5% to reduce smuggling. What it meant is an immediate reduction of domestic gold and silver prices by 5%. And added to that, there could be some negative sentiment for a while. So we could see that minus 1.33 for the week became minus 5.19, kind of a shock for the mutual fund holders. Minus 0.23 for the month became minus 3.74%, huge correction. 3.33 for 3 months became 1.99 correction. 19.68 for 6 months became 16.15, and 20.35 for 1 year became 16.46. So there has been a huge disappointment for those who are holding commodity mutual funds. That is sad. Now, with this 5% reduction, the new base definitely becomes attractive for the new investments. For those who are holding it, unfortunately, it's a bad news. Now, let's go to the next comparison. Here, I have focused more on the equity funds comparison because the equity fund behavior pretty much gives the sense for knee-jerk reaction. Let us see what was the scenario before the budget. Here to highlight the knee-jerk reaction, I have gone for the top 50 based on 1 week return. Usually I go for 1 month return. For this analysis, I have taken the top 50 based on 1 month return. And if you notice, these top 50 were led by IT funds in both the cases. But if you note, the top fund gave 1 week return of 2.28%. Here it is 3.14%. Okay, the average, if you look, 1.22 here, 1.52. So those numbers we have already gone through. So when it came to the top 50, there has been a positive impact, I would say, based on weekly top 50, and those who are green here are the one which have given above average return for timelines 1 month through 1 year. I have ignored the 1 week return for the same as usual, and the ones that made the cut are UTI Nifty IT ETF, Nippon India Nifty IT Index Fund, Navi Nifty IT Index Fund, HDFC Technology Fund, Kotak Technology Fund, Tata Digital India Fund. So they have positive 2-digit return for the month. However, their annual returns may be subdued because of the corrections that were there before. So the funds that made to the green are typically those funds which are newly launched and do not have data for 6 months and 1 year. Therefore, they could appear in the green belt. Except only one fund, Tata Digital India Fund, did make it through, above average return in all timelines from 1 month to 1 year. However, its annual return is 44.54, which is very respectable at this stage because it has recovered from the correction. Now, post budget, what has happened? Let us look at the leaders. Some shift in the leaders. UTI Nifty IT ETF, Navi Nifty IT Index Fund, Nippon India Nifty IT Index Fund, HDFC Technology Fund, Kotak Technology Fund, and Tata Digital India Fund still made it to the green. Okay, so similar leadership, and typically they are the ones which do not have data for 6 months and 1 year, except HDFC Technology Fund also has a results information for 6 months here, and Tata Digital Fund actually did not make a cut for 6 months. So I should have excluded that here. If you notice, or no, it is 15.36. I just missed to make it bold, so it is correct. Sorry. So there is a similarity of leadership before the budget and after the budget when you look at the equity funds, top 50 equity funds based on 1 week return. So I would say not much of knee-jerk reaction when it comes to the top 50 performance based on 1 week returns. Now let us look at the bottom 50 funds based on 1 week return. The lowest return was minus 9.68. Nippon India Taiwan Equity Fund, which is a foreign equity, as on July 23rd. And now the new one is Motilal Oswal Nifty India Defense Index Fund with minus 6.85. But there is a difference between minus 9.68 and minus 6.85. So the average you can see for the week minus 1.29 became minus 4.29. That means the bottom 50 for the week became worse, is what we see. And here wanted to give a distinction as to how the typical leaders are reversing from their leadership, and that is established by identifying below 1 week average return once marked in red bold, and above average 1 year return are marked in black bold. So those funds which have both the below average 1 week return but above average 1 year return are then highlighted with bold, red bold, meaning there is a correction, significant correction for these leaders. For example, HDFC Defense Fund made it to the list before the budget because now before the budget it has only 118.93 annual return, but adding minus 5.34% decline for the week, which is a bad news. We all know that this annual return used to be 147 point something. That means people who invested in the last 2-3 weeks lost significant money, is what you could say, so to the tune of 5 to 7% is what you could see. So post budget, what happened? Post budget, this HDFC Defense Fund again made it to that infamous list of having below average weekly return and above average annual return. So you could see that HDFC Defense Fund, the annual return reduced to 115 and weekly decline increased to 6.06%. Another two funds came into that list, HSBC Infrastructure Fund, which has 60.72 for the annual but minus 4.42%. UNESCO India PSU Equity Fund, 87.38% for the annual, minus 4.4 for the week. So if you look at some of the names here, realty index funds are there, and some flexi caps are there. Infrastructure and PSU fund being here is a disappointment. So you could say that in general some infrastructure funds are also there. So the realty infrastructure PSU funds and defense funds have been a bit of a disappointment post budget news, is what you could say. So we need to be careful about these type of funds in the days ahead, is the learning here. So this kind of summarizes the knee-jerk reaction of mutual funds. See, one disclaimer about this study is that mutual funds could be a bit lethargic as to reacting to budget news for various reasons. One, there may be some time they need to interpret the budget news impact to the overall investment strategy, or there could be simply a slow movement or action taken by mutual funds. Therefore, this knee-jerk reaction as such cannot be very crisp like in specific stocks. Still, this analysis gave us some insight as that overall budget has been a negative sentiment for the mutual funds, and some leading sectors like infrastructure, realty, PSU, and defense have been bigger disappointment post budget. So that sounds like there is a churn out in the leadership in the coming days. So one needs to be careful as to how the mutual funds will evolve in the next 1 or 2 weeks, and be careful. Personally, I took a decision to pare down my mutual fund investment by close to 1/3, 33% or so, because I had anticipated some kind of a correction post budget, which is more of a technical correction, was what I was anticipating. But post budget, my own personal assessment is there is a sentiment, investor sentiment being bit negative. Investors feel that they have been bit taken for a ride for various reasons I will not discuss. This sentiment may reverse over a period of time, but the correction fear, in my case, I felt it is far more higher now, because it is not just technical reason, it's also a sentiment reason. The overall economy in India will do well, and both equity and mutual funds will do well in the longer run. There is no doubt about it, because fundamentally economy will become sound as we go. But short term, I am of the opinion that there could be corrections. Therefore, 1/3 of my mutual fund investments, especially those which are underperforming or likely to underperform in the near future, I had sold prior to the budget. So I was very free to do this analysis with the open mind, because whatever I had to sell, I have already sold. In fact, now I have the money to buy new mutual funds post correction. So I will not only buy that 1/3 sold funds going into new mutual funds, I might bring additional money from fixed deposits into mutual funds, for the reason that the tax regime is very harsh for the fixed deposit, because fixed deposits will be taxed at the rate of your income tax bracket, which could be 15, 20, 25, 30%, depending on your income. Whereas if you play carefully with the mutual funds or equity or the real estate, you can come under the tax regime of only 12.5% long-term gain. So which you can ensure. So huge tax savings, where is 12.5 and where is 30% if you are in that bracket. And the returns also, a fixed deposit may give you 8%. Maybe it will go down if the interest rates will go down, whereas mutual funds will easily give 15 to 20% easily. So as a result, my commitment to mutual funds remain more positive in the longer term, but short term, I am anticipating some correction. This is my opinion. This is not an advice, nor I am asking you to do anything specific. It is just I am sharing my opinion. So with this, I am coming to the conclusion of this report. So I hope you find this report very useful. I will see you soon next week with the weekly report. Thank you.